Hey, good morning, everyone. Welcome to the Trade Station Masterclass. My name is Jesus Nava. I'm the Director of Client Training and Education for Trade Station. And it's always great to join you guys and talk a little bit about Trade Station. Today is our strategy trading or strategy elements series, where we talk about what strategy trading is all about and what are the tools in TradeStation that can help you develop a strategy. So let's get to it. Our topic today is Introduction to Strategy Components. So we're going to talk about strategy trading conceptually and the reasons why you would consider strategy trading and some of the tools on TradeStation that we provide in the area of strategy development. But before we jump into today's topic, here's the usual disclosures. Keep in mind that every symbol and idea that I talk about is for educational purposes only. It is not a recommendation of TradeStation. Also, that active trading is not suitable for everyone, and it should only be done with the risk capital. Past historical performance is no guarantee of future results. And if we do look at a strategy performance report, I want everyone to be aware of that fact. There is a link right there on this PowerPoint slide, www.tradestation.com/important information for those of you that need a little bit more detail on those disclosures. Let me go ahead and share with everyone the link to today's PDF. That way you have the information with you. Give me just a moment while I share that with everyone here. The chat is open and is also public, so you are welcome to make any comments, feedback, questions, and we'll address those as we can. I do ask that if you're going to put anything in the chat, that you set your chat windows to everyone, and that way everyone can see your comments, your questions, and we can all follow along. It'll become a more interactive class, okay? I may use TradeStation in this presentation. I know that last time when we talked about the introduction to strategy trading, we didn't go to the platform, but we can decide whether we want to show you things on the platform as we go along, especially if you have any questions about what the TradeStation platform supports or not. But let's go talk about a little bit about strategy trading. First thing is, what are the elements that you have to develop strategies on TradeStation, and essentially, what is strategy trading? Because a lot of times, we have experience trading, but we don't really know what strategy trading is when it comes to a software package that helps you develop a strategy. So strategy trading is just a set of historically tested rules for entering and exiting the markets. So this is pretty much automated trading, where you tell a computer exactly what your rules are to enter and exit a trade, and the computer will do the trading for you. Now, TradeStation, of course, the platform has many stages when it comes to automating a trading strategy. You can have, what is called fully automated strategy, which is just letting your computer do the entries and exits. But there's another one that's kind of where the user still has a certain control over the strategy. So you're not letting everything be automated. You still want to interact with your strategy and be able to confirm or deny the trades that are being generated. Of course, if you are interacting with the strategy, sometimes that defeats the purpose of having a rule in place, because once you have that manual interaction with a strategy, you may choose to not follow the rules that you developed in the first place. So that's some things to consider. But I'm just saying or talking to you a little bit about what TradeStation provides, so that you don't have to be completely scared about developing an automated strategy. So we'll take a look at those different stages in the automation process, especially tomorrow I have there's a webinar that you can find in the events tab. If you are on youcantrade.com, on the left navigation, there's an events tab that gives you upcoming webinars. And tomorrow in the afternoon, I believe it's at 2 p.m. Eastern time, I'm going to do a presentation on the automation process and maybe talk a little bit more in detail about what the automating of a strategy entails. Okay, so what we know about strategy trading is that you have a set of rules, and these rules are intended to enter and exit the market. We want to encourage everyone to test trading strategies on time, activity, and or price-based bars. If you've been with TradeStation for some time, you know that TradeStation platform provides all those types of charts. So you have a time-based, which is the most popular, if I may say so. In the sense that when you pull up a chart in TradeStation, the first thing you see is a time-based. I mean, the default is a 5-minute chart of a stock. Of course, you can change this, and you can build your charts based on activity. Activity is a very interesting way of building candlesticks or building bars inside of a chart because it's sensitive to activity. It's sensitive to volume. And a lot of times, you know, if you want your strategy to react to these higher than usual moments in the market, then activity would be a very interesting way of developing a strategy. And you also have the ones that are price-based. We talked about this a little bit last week. If you were here, we talked about developing a Renko or a strategy on Renko charts. We saw some of the limitations. We saw some of the inner workings of the strategy when it's applied to price-based. But this, you know, bullet point right here just shows you that you can develop a strategy on all these different, you know, types of charts. So if something is not working on time-based, you know, bring it over to activity or price-based and see what the performance is on that. One of the things that we talked about last week and I made a big emphasis on is that we need to understand all the details about the strategy and how it's generating the signals. If you don't fully understand market behavior and how it interacts with your strategy, then you are in a scary situation because the lack of understanding is going to make you doubt the strategy. It's going to make you second guess what some of the trades are being generated, and some of those are the pitfalls of, you know, having a successful strategy development. So a little bit about what we said earlier. Understanding strategy trading is a natural evolution for every trader, and if you're not, if you're not doing it with the intention of fully automating a strategy, it's totally fine. You know, if you're doing it just for the educational value and be able to understand your strategy better, I think that is even better, because that understanding of the strategy and how it interacts with the strategy, I mean, with the market behavior is what's going to give you that extra edge of, you know, being fully comfortable with your strategy rules and being able to trade them going forward. So we do need to determine the type of trader you want to be. There is a slide in the PDF that talks about different styles of trading. And of course, you know, we talk about combining a specific time frame with a specific chart because of the frequency in which the strategy trades. We know that very easily you can take a strategy and change the time frame of a chart, and TradeStation will do all the calculations again. So even if you developed and designed that strategy to work on daily bars or daily candlesticks, once you switch it over to intraday, you may have the strategy work well. It's just using a different time frame. But what you're doing is, of course, affecting the way that the strategy reacts and the frequency in which the trades are being generated. It's not the same thing running a strategy on daily candles where the strategy is being calculated on a daily basis. So every day you have new orders being generated. Then running a strategy, for example, on a 1-minute chart, because every 1 minute, the strategy rules are evaluated, and you could potentially have strategy orders every single minute. So you can see the difference there. You know, one is highly active because of the time frame. The other one waits for a daily bar to complete. So yes, thinking about charting, thinking about time frame, of course, is gonna also determine the type of trader you want to be. Do you want to be in the intra-day kind of trading where you get in and out of positions in a day? Or do you want to be more of a swing trader that takes, a few days to analyze or be in a position and then make decisions towards that goal? Or do you want to be more like a position trader? So the next, a future slide will go into more detail about this, but those are things to consider when we are developing strategies on TradeStation. Stay focused on a few things, meaning that do not overcomplicate strategies. I know there are some very sophisticated strategies out there that do perform well, but you don't necessarily have to complicate things to have a strategy that really works. You guys know that we are, as a company, TradeStation, we are not in the business of providing you, strategies or winning strategies or have you pay for strategies, because that's not our business model. We give you the tools, you take the strategies, and then you do your own testing, decide whether you want to continue using that strategy or not. But the fact that we provide you with different styles of indicators and different styles of technical calculations does not mean that you have to use them all. I mean, if you go to the list of studies instead of a chart analysis, it's incredible the number of technical parameters and the number of different signals that you can put into a chart. Anything from a moving average to MACD to Bollinger Band, RSI, parabolic, whatever it is that whatever it is that rocks your boat, then it's fine. But overcomplicating things and trying to bring all these components into a strategy may be challenging. So that's why this bullet point says stay focused on a few things, pick, a few components and see how they behave. And if they don't behave well, maybe go on to something else. Do not get married to certain technical ideas just because they're popular. Maybe you will find something that works for you that hasn't worked for other people, and start testing your ideas. And this is where TradeStation shines as a platform. Having software ready for you to take an idea and apply it and test it against historical data, I think that's very valuable. And you all, as TradeStation clients, have access to this very sophisticated software that's been developed for the past 40 years to help you in your strategy search. All right. So benefits of using a strategy. Let's go through this quickly. Eliminates emotion. Greed and fear are known to affect your your trading decisions. If you have a strategy, which is a defined set of rules, then you're removing emotions. There's no greed. There's no fear, because everything is being decided by the strategy and the rules that you've established. If you start interacting with the strategy, of course, you're going to allow, these emotions to creep up on you and start making you doubt the strategy. You have a consistent approach. You're not changing things on the fly. You're not saying, well, today I feel I'm trading 100 shares, next trade, I feel like I want to trade 1,000 because I feel this is my lucky day. I feel it more. No, you're not changing things on the fly. You're not winging it. Everything is consistent, is based on a rules that you've established and that you have tested and that you're confident on. It helps you measure and manage risk in the sense that you already know what the potential losses are. Of course, if you have the right components in place, but if you have a complete strategy, I'm going to assume that you've incorporated some risk management, and for a fact, what's the maximum that you could lose or the maximum you could gain. You're managing your money, and it's implemented into the strategy, and that's why it helps you measure and manage risk, reduces stress. Trading is a stressful job, putting in a trade, and I felt it before. You put in a trade, and you can feel it in your stomach. Some people don't have the stomach to tolerate trading. I may be in that category, but it is a very stressful job when you put in a trade, even if it's strategy, and a strategy automated trade. Once you know that you are in a position, then it's a stressful situation. However, having the strategy, manage your exits and manage your entries, then it reduces those stress levels, because you're not making those decisions. I mean, you're pretty much stressed because you are in a position when you're, strategy trading, but it's reduced significantly because you're not making the decisions to enter or exit. They're handled by the strategy. Clarity of potential. This is on the movement. You have an understanding of how the market moves, not overall, the specific instruments you're trading. If you're trading a specific stock, let's say Apple, and you're trading in a second stock, let's say Twitter, price movements from Apple and Twitter are going to be totally different. But this understanding of how each one of the instruments you're trading move is going to give you clarity of potential. What is the potential of each one of these stocks to move in a certain direction? And last time when we did this class, and this is something that everybody needs to think about. Let's say, for example, you have 100 shares of stock XYZ. It doesn't matter what stock it is, XYZ. And your target, let's say that you want to make $1,000. If you want to make $1,000 off of 100 shares, there's got to be a $10 movement for each one of the shares. You have 100 shares times $10. That gives you the $1,000 target you're trying to get. Now that could be called a strategy. That's my strategy. However, we go back to this bullet point, which is clarity of potential. If you're looking at, for example, Twitter, and for a fact that Twitter moves about $1 or less, maybe 75 cents on a daily average, that's not even close to the $10 that you're striving for. If, let's say, for example, let's round it up to $1. Let's say that Twitter moves $1 a day, and this is up and down. It's not going to be in a continuous trend. If it goes in a continuous trend, $1 higher every single day, you would have, you would know that in 10 days worth of time, you would reach that $1,000 of movement. But this is where it comes. This is where it boils down to. What is the potential of the instrument that you're trading? If something is moving $1 in average every single day, then you have to understand, how long is it going to take me to reach my potential? There's some clarity. Once you understand how the instruments are moving and the rules that you've put into the strategy, then everything is more clear. Understanding of analysis. Of course, this goes back to the rule itself. When are my signals being generated? Are they being generated on the crossover? Are they being generated when a certain bar formation is being identified? Whatever it is, having that understanding allows you to make changes on the fly. We all know that the market is it's a big animal. It's a big animal that needs to be tamed, and it doesn't behave the same every single day. So having this understanding of your strategy rules, everything, the tiny details, allows you to make changes to those details as the market evolves. If the markets are changing, then of course your strategy must have that flexibility. And it's not until you have an understanding of the rules of the strategy that you can make changes on the fly. So if the market's doing this and is behaving this way, I want my strategy to do this particular type of signal. So in the strategy building process, these are the things that you're going to have to go through in order to have something that you have confidence in trading. The first thing is that you develop and visualize an idea in a chart. That's where it all begins. You have to be able to sit there in front of your trade station, look at a chart and say, I find this pattern interesting. I find it interesting that these two lines are crossing at these precise moments. Now, those are the type of visuals that everybody has to be able to identify in a chart and be able to say, what if I would take a trade when this happens? Now, those are the type of visual aids that anybody that's developing a strategy should go through. Looking at a chart, sit there, visualize, and see how the entries and exits would have been generated. And a lot of times we get married, as I said at the beginning of the presentation, we get married to specific technical idea, like I'm marrying the Ichimoku cloud just because there's a big following of it, and you try to mold that technical idea to the chart, and you try to fit it so you can see trades that are not there. It should be the other way around, where you are looking at a chart raw. Yeah, maybe you're introducing the Ichimoku cloud, but you're not dictating the technical analysis. You're not letting the technical analysis dictate that this is a good trading strategy or not. You want to look at the chart first, and then when you apply the technical idea, then you want the price activity to tell you if that technical idea works or not. Create the rules. So once you see it, once you want to test a specific entry and exit based on price movements, then create the rules. And everybody here knows that creating the rules requires a little bit of knowledge of easy language. So you need to program your strategy. And we've done it here in class. We sit here and we program easy language so that TradeStation understands what the rules are. So that's what we mean by create the rules. And once you have that rule created and written in easy language, you put it on a chart, and it's a beautiful thing because TradeStation is capable of using those rules and finding every single instance where the strategy would have generated a trade. That is something fascinating, and it happens so easily. You just have to load an amount of historical data, and the strategy will find every single instance where it would have generated a trade. So very easy to do. I guess the hardest part here is to program the rules in easy language. But once you have the rules created and you've applied them to the chart and you can see the entries and exits, then comes optimization. Optimization is the process by which we test strategy parameters. And what we call strategy parameters are the things that you could adjust. For example, if your strategy is looking at a 20-bar moving average by default, what if you change that to a 15-bar moving average? What would happen if you change it to a 25-bar moving average? Well, optimization is going to do that for you in a much faster way, where it's going to test variations of your parameters, the parameters that you have identified, so that it finds the ones that would have generated the best result historically. Be careful because you could be curve fitting a strategy to historical data, which is the worst thing you can do. Once you have a strategy that is curve fitted to something that happened historically, the likelihood of that strategy doing the same thing going forward is null. It won't do it. Very unlikely to have the same performance because you pretty much fitted the strategy to historical data, and it's impossible for the market to move exactly the same way. We talked about the market being a huge animal, and it is, and it moves like an animal sometimes with the strength of an animal, and having a strategy that fits to a specific time segment, that's not going to work going forward. So what I want everybody to think about, and when we use optimization, is that it has to be used in a way that benefits you and it benefits the strategy. We have a class on optimization, so I'm not going to go into detail about all the different ways in which you can optimize, but you need to optimize in a way that you're finding parameters that are consistent, that are consistently giving you good results, no matter what the backtesting data is. That's when you know that you found something robust, when the performance does not deviate that much from the mean when you're changing things around. That's what we want to accomplish in strategy development. Once you optimize, then we have real-time monitoring. Now this is even something that you can do without even risking capital, in the way that you don't want to turn it on and start trading real money from the get-go. It's not like that. I wouldn't suggest anybody here do that. Our recommendations would be for you to turn on the strategy for automation, but for display, where you can see the orders being generated, so that you can get a feel of how the strategy is generating all these orders, and measure the frequency, measure the effectiveness of these orders. And that can be done on a trading simulator, so you don't have to risk your capital. That is an exercise that everyone needs to go through. How much time do you have to do this? It all depends on what your development of the strategy tells you. Am I at a stage where I feel like the strategy is good, is robust for me to go and test it on live data and real money? When that's a decision that you have to make. But we provide you the tools so that you can have a visual monitoring of the strategy on money that is fake, paper money. And that's a great way to test the strategy performance. And then, of course, strategy automation and trading. There are some check boxes in TradeStation that allow you to automate strategy entries and exits. You do have to jump through some hoops in order for strategy to be fully automated. So don't be scared of inserting or adding a strategy to a chart, because it's not going to be automated from that, inserting. It's not from the get-go. You have to turn on automation for it to trade by itself. Okay. Some strategy building blocks. Of course, some of the building blocks that we're going to talk about here are some of the things that you can put into the strategy. It doesn't mean that you have to have every single item in here into the strategy, because we talked about the complexity of the strategy, how sophisticated it is. We want you to focus on a few things. Do not feel like every single item in this slide has to be put into the strategy. So we have technical entries and technical exits. Those are pretty much self-explanatory. Money management is something essential for any strategy. You have to manage your money. You have to manage the entry and the exit. Sometimes, and I do this all the time because it's easy to put on a strategy that's a reversal strategy. And for example, if I wanted to do a moving average strategy, now that's a simple idea, because every time the price crosses that average, there is an entry being generated. If the price crosses above, then that's long. If it crosses below, that's short. So an easy strategy that I put on a chart very, very quickly, it's a moving average that flips you back and forth between long and short. But that's not including money management, because a strategy that only flips you back and forth between long and short, it's risky, because you could be in an open position when the market's going against you and there's no signal or there's no strategy that's going to get you out unless you have an opposing signal. So very risky. And whenever you have a strategy that flips you back and forth between long and short, you must have some money management, so that if the market goes against you, then of course the strategy can react and get you out. All right. Thank you, Matthew, for sharing that link. Okay, let's go here. Trade size and account risk, other components to think about. You cannot always trade 100 shares of the instrument that you're back testing, the strategy by default uses 100 shares. But if you're trading something like Amazon, I'm not sure what the price of Amazon is today, but let's say, for example, it is $3,000, and you multiply that by 100, that's going to give you a trade that's $300,000. So if you do a back test on Amazon and you're doing the default 100 shares, you know that when you turn on the switch on the live account, you must have enough capital to support that. So if you're trading 100 shares, you must have, the $300,000 in your account to be able to trade those 100 shares. So put a lot of thought into what size is my strategy trading and how much risk am I taking? If you have a $30,000 account and you can only put 10 shares of Amazon, but you're using all your capital in that position, how much risk are you taking? How much is Amazon moving up and down? What is the potential movement against me, and what does that translate in dollars? Not only how much does it translate in dollars, but what does that translate in a percentage of my account capital? Am I risking more than 2-3% of my account capital? Am I risking more than that? Maybe those are things that you should consider every time that you, of course, test a strategy. Technical setup or filter. When it says technical setup, of course, it's just getting the strategy ready to trade. A technical setup can be whether you are above or below a moving average, which is just a setup. It's not an entry signal. It's just defining the mode of your trade. For example, if you're above the average, your mode can be bullish. If you're below the average, it can be bearish. So when you're bullish, there are certain entries that you want to take. And if you're bearish, there's maybe some other entries or signals that you want to take. So yes, sometimes we develop a strategy where you have these modes that you get into. And when these modes are aligned, then you can use those as ways of filtering your trades. Multi-time frame analysis, interesting. If you want to bring in other time frames in the mix, you can. We've talked about multi-data analysis. So if you're trading a 30-minute chart, but you want to make some technical calculations on a 1 minute, so you're running calculations on the 1 minute, and then you generate a trade on the 30-minute, that's something you can do. Confirmation. So yes, having different rules aligned and be true at the same time. So that's like confirmation. If this happens and that happens, and the third thing happens, then you have a more robust signal, a little bit more strength on that signal. Overall market behavior. So yes, have a mechanism for the strategy to look at overall market behavior and make decisions based on that. And the triggers, of course, these are the go in, go out, get in, get out, so those are the things, are the triggers. Stop loss and profit targets, trailing stops, and time-based exits. So those are pretty much straightforward and self-explanatory when we talk about this is my stop loss, this is my profit target. I'm going to be using a trailing stop instead, or something that is time-based. So it's been a while since I entered the position. Nothing has happened. Let me get out. That sort of things. Now, here we have a slide with 12 building blocks. Do not feel that you have to have every single one inside of your strategy. Some of them are a must, but some of them, are optional. For example, money management, I think it's a must. Stop loss and profit targets, depending on how you're exiting or entering the market, could be necessary or not. But yeah, you don't feel like you have to have every single building block in the strategy that you're developing. When it comes to strategy orders, you can buy, you can sell short, you can sell or buy to cover. These are actions that are more like trade station order actions. And it's interesting that you have to stick to them. I'm not sure if there's any futures traders here in class, but if you're going to be selling short a futures contract, you just usually say sell. I'm going to sell a contract, and that means that you're short. But when it comes to easy language, the word sell, just by itself, sell, does not open up a short trade for you. The word sell is designed to only exit a long position. Only exit a long position. That's all that it does. So if you want to develop a strategy for futures and you want to go short a contract, just be aware that you have to use the syntax or the name sell short for it to be more specific, okay? And the order types that we have in easy language, of course, you can generate a market order. Those are the ones we use the most, just the starting phase. And you can refine those orders by using limit or stop, but those are also accessible from within the language. Trading styles, of course, we have the day trading. We talked about this a little bit. If you're running a strategy instead of an intraday chart, 1 minute, 5 minute, the likelihood of your strategy to enter a trade is more than if you were trading that strategy on a daily chart. I'm not sure if you guys are aware of this, but a strategy that you put on a trade station chart is calculated on the close of the bar, once on the close of the bar. So if you have a 1 minute chart, of course, every minute your strategy is recalculated and new orders are generated. If you have a daily chart, your strategy is only calculated once per bar, once per day. So you can already tell, the frequency in which the strategy is going to trade. If it's going to be a day trading strategy, then make sure that you have a strategy that, or at least a time frame that fits that style. A swing trader, this is a longer intraday bar interval. You can use momentum, support and resistance. Trades are kept from a few days to a few weeks. And then you have a position trading where you're trading on daily, weekly, monthly bar intervals, momentum, a few weeks to a few months to hold that position, right? Let's talk about trending strategies. So we have trending strategies and we have the counter trending or mean reversion. TradeStation provides a collection of both, and you have to determine, what your strategy is going to be. Can it be both? Of course, I don't see a reason why not. You can have a strategy that looks at the market overall, and if the market is moving within a channel, maybe your strategy is using signals that are counter trending or mean reversion. But if your strategy identifies that the price action is going into a trend, then it switches. It can switch over to your trending signals. So what are the characteristics of these strategies that we're going to be using? On a trending strategy, you're going to buy higher and sell higher. Okay, buy high and sell higher. The profitability target on these strategies is going to be anywhere from 40% to 45%, which is kind of contradicting. You may say, well, if I'm only winning 40 or 45% of the time, how is that a profitable strategy? Because your winning trades should be larger than the losing trades. Let's suppose that you have a strategy back test that has a total of 10 trades. Looking at the 40% profitability, that means that 4 of those 10 trades are winning and 6 of those 10 trades are losers. But if your winning trades are larger than your losers, let's suppose that my winners are $250 each, right? If I have 4 winners and I make $250 on each one of those trades, that's a total of $1,000 of profit. Let's suppose that my losers are only $100. I have 6 losers, so I lost $600 in total. If you take the $600 loss from your losing trades and you add it to, or you combine it to the $1,000 profit that I made on my 4 winning trades, then you have a net profit of $400. So that's the way that you can have a strategy that's only profitable 40 to 45% of the time and still make money because you have winning trades that are larger than losing trades. And of course, it works on longer bar intervals. What type of strategies are we talking about when we talk about trading strategies? We're talking about moving averages, MACDs, momentum, linear regression, price channels. And of course, we have components inside of TradeStation that allow you to test any of those strategy ideas. On the counter trending or mean reversion side, we're going to buy low and sell high, or sell high and buy low if you are on the short side. But you're taking advantage of consolidation or consolidating periods where the price moves up and down within two levels. The profitability target is going to be around 55 to 50%. The reason for that is because a lot of times on these strategies, the winning trades and the losing trades are going to be about the same. So you want that percent profitability to be above 50%. If every single trade makes $100 and every single trade loses $100, if you have the same 10 trades that we talked about earlier, if you have 4 of the trades losing and 6 of the trades winning, then you have the same result. You want to make sure that if your trades are about the same, the same amount of loss that they're gaining, then by keeping them above 50%, you're going to have at least a profitable strategy. You're on the green side. Some of these strategies are going to be price channels, stochastics, RSI, Williams percent R, or even some chart patterns that are quick, shorter term trades. Okay. Perfect. So use that as a way of looking at different components and elements that you can introduce in your strategy development. If I come over here to TradeStation, I'm going to do that very quickly. Let me get rid of my, okay. So right here in my TradeStation, let me show you how quickly you can do that. I'm going to go to apps, chart analysis. Let me put in this is a 5-minute chart of the treasury bonds. This is the futures on the treasury bonds that expires September 2022. Now let's do something simple. I'm going to do studies and add studies. I mentioned the moving average being a simple strategy. Let's put it right on top. So moving average, one line. I'm going to make this a 30-bar moving average. All right, 30 bar, meaning that when the bars cross to the upside, it's going to go long. And when it moves down, it's going to go short. So one of the bullet points that we saw in one of the slides said strategy trading starts, looking at a chart and finding the visual aspects of where the trades would have been generated. Today, it would have been a great day for the strategy. Why? Because we have multiple signals being generated. Like over here, we dipped to the bottom side, but then we crossed over to the top and they maintained that trade until this level right here where it went down. But over here, it entered again on the long side and then it exited right here. So yes, it is a visual exercise. Take a look at this trade right here. It crossed the moving average and then it just kept that trade all the way until it reached up here. So today, not such a bad trade. And everybody here, when you're developing strategies, you're looking at a chart and you're saying, well, if it enters here and exits here, that's a perfect trade. It's not always the case like that, and you're going to see some trades that are going to be hurting you. But rather than sitting here and looking at all the historical data, but in this case, it's only 5 days. Let me put in 30 days of historical data. And did you see how quickly I did that? Requesting historical data is one of those things that you don't even, think about because it's granted by TradeStation. TradeStation has this amazing and extensive historical database that you can tap on and test any idea. And all I did here was type in 30 days and TradeStation gives me 30 days. And I can do any amount request. I can type in 1 year with my keyboard, hit enter, and I'll get 1 year worth of data on the treasury bonds futures So it's beautiful, right? So let me go here and put in a strategy. Studies, add strategy. TradeStation comes with built-in strategies that you can use out of the box based on popular ideas. It does not mean that you have to stick to them. TradeStation just provides them as components for you to mix and match, and to get you started on this, process of developing your own idea. So rather than start from scratch on your ideas, take a look at the ones that are built in, have an understanding on how the whole process of strategy backtest, optimization, automation works, so that once you have that understanding, then it'll be easier for you to develop your own idea and apply it to TradeStation. So here, add strategy. I'm going to go here to the moving averages. Okay, long entry. There's multiple moving averages. I'm just going to use the long entry and the short entry. That's the way that the strategy components are labeled right here. The LE is long entry and the SE is short entry. I'm going to put them right here on the screen. And you can see that it finds every single trade. Well, actually, no, I need to change the parameters because it's not using 30. It's using the default 9. So let me customize here and change it to 30, which is the parameter that I used on the line. And here we go. Now you can see that those areas where we identified the crossover, now we have a signal, and that happens automatically. You can see that today we have some very nice winning trades. The strategy finds every place where it would have generated a trade. It also gives you a connecting dotted line between the signals. And we can see that we have a lot of blue. Blue means profits. Red, we have some losing trades over here. The most recent trade today was a losing trade because it went short on the cross down, but then it went cross up. Again, this strategy is relying on the flip back and forth to get you out of a trade. It has no, well, I guess that could be a form of money management, but still, we have to think about the strategy and realize that this is not complete. But let's go ahead and look at the performance report, which is what we want to do every time we put in a strategy. And that's like, it's an itch, right? I mean, you put in the strategy, you're looking at the signals. All you want to do is how well did it do? Just go to data and go to strategy performance report. And this is what it did. I'm going to go here to the performance summary. And it's a strategy that failed miserably. And I wasn't expecting any good results here. Either way, I mean, the idea here is not to show you a winning strategy, but give you the tools that are here for you to test different ideas. So in 30 days, I managed to lose $16,000. But this is a strategy sandbox that I'm sure anybody that hasn't used it is going to enjoy using it, because I can make modifications to my strategy on the fly and see how it affects the strategy performance. For example, if I change the time frame to daily, of course, daily would not be very realistic because there's only 2 trades that were generated in the historical backtest, because this is a futures contract. It doesn't have much historical data. If I wanted to switch this to @US, so on @US, which is the continuous contract, then look what the strategy is doing. It's a profitable strategy, not to encourage anyone to trade this, because we said at the beginning, TradeStation is not in the business of recommending, but it's interesting how we can just make a slight, change to some of the components in the strategy backtest and get some quick, different results. All right. All right, guys, that's my class for today. I hope that you guys enjoyed the content. Sometimes I go into more detail about some of the tools that are on TradeStation, but I wanted to introduce this concept to everyone. Jim is saying there's infinite ways to have bad strategy. Yes, like I'm always, very, very, very quick in giving you bad strategies. So I'm an expert at giving people bad strategies. Exactly. And good strategy ideas, of course, come from hard work, hard analysis, hard development, And I want to encourage everyone to use the tools that are in TradeStation to develop, some very good and robust strategies. Right, guys? Thank you for your time. Thank you for being here. Thank you for being part of the TradeStation Masterclass. And I'll see everyone tomorrow at 11:30 in the morning Eastern Time for our easy language class. All right? Talk to you later. Have a wonderful afternoon.